I was recently listening to an insightful conversation between Barry Ritholtz of Ritholtz Wealth Management and the noted American financial theorist and neurologist Dr. William Bernstein, who were talking about the consequences of overconfidence in investing. Barry asked Dr. Bernstein, do most of us really believe we are smarter than the market? Do we really think we are stock picking or market timing geniuses? And Dr. Bernstein replied, we sure as heck do. Whenever you trade a stock, you're saying that you're smarter than the person on the other side of the trade, which is generally not true. And when you think that you can time the market, you're saying that you're smarter than the collective wisdom of the market, which is not true more than 90% of the time. And if that's not overconfidence, I don't know what it is. I believe Dr. Bernstein's point is very important here. Every trade implies a belief that we have an edge over the other party, which is often not the case. It's important to understand that the market, with its collective wisdom, is a formidable force. Thinking we can outsmart it consistently is a classic example of overconfidence. But the question is, why do so many of us fall into this trap? Well, I think it's part of our natural tendency and the way we have evolved over thousands of years. We tend to overestimate our abilities, which is a cognitive bias known as overconfidence. This bias leads us to believe that we are better at making decisions than we actually are. Like every time I hit the publish button on my videos and articles, I tend to become confident that thousands of people are going to watch or read it and send me messages about how much they love my content. But the reality is far from that and shows a lot about my overconfidence in my abilities than about people wanting to consume what I share. Anyways, when it comes to investing, overconfidence can be particularly dangerous. Data upon data shows that most individual investors underperform the markets over the long term. The belief that we can pick the right stocks at the right time is often an illusion. The market is influenced by countless factors, many of which are unpredictable and outside our control. Even professional fund managers struggle to consistently outperform market indices. Dr. Bernstein says in the interview with Barry that there's an overconfidence that's even worse than the overconfidence of stock picking and market timing. And that's overconfidence about your risk tolerance at the top of the market. Everyone's a long-term investor, and they often overlook a key insight from Warren Buffett, who said that only when the tide goes out do you discover who has been swimming naked. This means that in bull markets, people overestimate their risk tolerance. The real test, however, comes during a market downturn, which can be more painful than anticipated. I think Buffett's insight perfectly encapsulates this idea. Their theoretical understanding of risk is very, very different from the lived experience of losing your hard-earned money. No words or pictures can truly convey the emotional impact of significant financial losses. And this is why it's very important to have a realistic assessment of our risk tolerance. Now, financial advisors often use questionnaires to gauge an investor's risk tolerance, but these assessments can be flawed if taken during market highs. Overconfidence can lead to a mismatch between an investor's perceived and actual risk tolerance. And so it is important to periodically reassess your risk tolerance, especially during different market conditions. Let me bring in some research from behavioral economists to share some light on this issue. Studies after studies have consistently shown that overconfidence is not just a minor flaw. It leads to excessive trading, it leads to higher transaction cost, and ultimately poor long-term returns. A study, for example, done by Brad Barber and Terence Odin in 2000 found that individual investors who traded frequently earned significantly less than those who traded infrequently. This is a classic case of overconfidence leading to a detrimental financial outcome. Now, overconfidence does not just stay confined to our financial decisions, it spills over into everyday life, sometimes with fatal consequences. Just consider the phenomenon of dangerous selfies. More people die each year from taking risky, dangerous selfies than from shark attacks. This startling fact underscores how overconfidence in our ability to handle risky situations can lead to tragic outcomes. A study published in the Journal of Family Medicine and Primary Care in the US found that between 2011 and 2017, there were 259 reported deaths from selfie-related incidents worldwide, and most of those deaths happen in India. These fatalities often occur in treacherous locations like cliffs, rooftops, and bodies of water where individuals overestimate their ability to stay safe while capturing the perfect shot. Now the question is, why are we so prone to overconfidence? Well, behavioral scientists have some reasons for that. The first reason is the illusion of control, where we believe we have more control over events than we actually do. Another is confirmation bias, where we seek out information that confirms our beliefs and ignore evidence that contradicts them. In an experiment done by E.J. Langer in 1975, people were asked to choose lottery tickets. Some picked their own numbers, while others were given random tickets. Those who picked their own numbers were willing to pay much more to retain their tickets, showcasing the illusion of control. They felt more confident in their chances of winning simply because they chose the numbers themselves. Financial history is also replete with examples of overconfidence leading to financial ruin. During the dot-com bubble of the late 1990s or the financial markets boom of 2006-2008, many investors believed they could pick the next big winners, and the subsequent crashes wiped out trillions of dollars in the market value and left countless investors grappling with heavy losses. There was a study done by Marcus Glazer and Martin Weber in 2007 where they examined the self-assessment of investors' own abilities. They found that investors consistently rated their own investment skills above average, despite evidence to the contrary. And what is this overestimation of personal skill, if not a direct proof of the overconfidence bias? Anyways, while overconfidence is a deeply ingrained bias, there are ways to mitigate its impact on our lives and investment portfolios. One general and effective approach is mindfulness, which helps us stay aware of our cognitive biases and make more rational decisions. When you know how your brain has evolved and that most biases have helped us survive over thousands and thousands of years, you will be more thoughtful and mindful about the presence of these biases, like overconfidence. Then let them drive you into decision-making mistakes. Now, apart from mindfulness, when it comes to investing, diversifying our investment portfolio is another practical strategy to get over some kind of overconfidence bias, because diversification helps spread risk and reduces the impact of overconfidence in any single decision. Consulting with an experienced and trustworthy financial advisor and continuously educating yourself about behavioral finance can also help counteract overconfidence. A good advisor can provide an external perspective and can help temper your overly optimistic assumptions. Let's look at overconfidence as a double-edged sword. While a certain degree of confidence is necessary for success, too much can lead to poor decisions and adverse outcomes. When we recognize this bias and actively work to mitigate it, we can make better financial choices and lead safer and more balanced lives. And always remember, true wisdom lies not in overestimating our abilities, but in understanding our limitations and acting accordingly. If you found this video insightful, don't forget to like, share and subscribe to my channel for more content on investing, decision making and human psychology. Thank you for your time and attention, and see you in the next episode.